Good morning and welcome to the NAHL Group PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to James Sorellis, CEO. Good morning, sir.
Thank you, Alessandro, and good morning, everyone. I'm James Sorellis. I'm the Group CEO of NAHL, and I'm here today with our CFO, Chris Hine. It's our second time on the IMC platform, and we're glad to be back. It gives us a great opportunity to engage with a wider audience and talk directly to you about the company and try and answer your questions as well. We hope to be doing more presentations later in the year, and we also have our AGM planned for June. I'm hoping that we might even see some of you then. It's the normal format today. Chris and I will walk you through a presentation which accompanies our 2021 prelims, which we released on the 29th of March. If we flip over the slide, Chris, thank you. You can see a short agenda on the screen now. This will probably take us about 40 minutes to work through, and then we'll try and answer any questions you have afterwards. So in all, probably about 50 minutes in total. First of all, to anyone watching who are thinking, who are NAHL Group PLC? Well, hopefully, first of all, you're not in the wrong webinar, but perhaps you're new to the company or it's been a while since you looked at us. So to give you a very brief introduction, NAHL is a leader in the UK legal services market and primarily in personal injury or PI. We operate through two trading divisions, which we call Consumer Legal Services and Critical Care. Consumer Legal Services provides outsourced marketing services to third-party law firms through our National Accident Helpline brand and also through Home Legal. And we also provide claims processing through our two joint ventures, Your Law and Law Together, and also our own law firm, National Accident Law, or NAL, as I might refer to it as later on. In critical care, we provide a range of specialist services in the catastrophic and serious injury market to both claimants and defendants through a business called Bush & Co. And that's still in PI, but it's dealing with claims resulting from the most severe injuries and claims with a value that's usually over £500,000. Bush & Co is a market leader in both case management and expert witness services. Now, I'm not going to spend any more time on the background to the group today. If you are new to the business, then I suggest you watch our presentation on IMC from September, which explains the divisions in more detail and also sets out our business model. So please go and do that if you want to. And then finally, before we start, just to mention that our brokers, Allenby Capital, initiated research last week, and their analyst has written a comprehensive note that provides a good overview of the business. It's worth knowing that you don't have to be a client of Allenby to have access to the note. You can download it through their website, or you can go to our website, nahlgroupplc.co.uk, and you can find a link from our investors page. So if we can move on to the first slide. So what happened in 2021? Well, we've been working hard to build a stronger, more sustainable business despite the headwinds presented by COVID-19 pandemic. And we've listed 3 areas of focus on the page, and we're excited to share our progress with you today. Firstly, we've committed to investing for the future, but we said that we'd do this in a controlled manner. And I'm pleased to report that we've reduced our net debt in the period. We've put the financing that we need in place through to the end of 2024. And despite the challenges of COVID over the past couple of years, we haven't had to come back to shareholders to raise funds to do this. And whilst we've been doing this, we've also returned a profit in 2021. Secondly, we said that we'd develop our fully integrated law firm, NAL, and we've done that. You'll see today that we've accelerated inquiry numbers into NAL. We've reduced our reliance on joint ventures, where we have to share the profits from claim processing, and we can demonstrate a 62% increase in cash received in NAL in the year from settled claims, which is important. And the third point is that we said we'd work hard to recover from the impact of COVID in critical care, and we've made great progress with that. We've grown our revenues in 2021. We've increased the volume of reports that we issue to actually exceed pre-COVID levels, which is great. And we've launched some new initiatives which should contribute in the future. And as a result of all of this, we're more confident in our ability to deliver strong cash generation and deliver greater returns for shareholders as our investments mature. And we've already have visibility of a growing pipeline of work to drive this growth. So next, we're going to review the financial performance. And to do that, I'm going to hand you over to Chris to talk you through the results. Chris.
Thanks, James. I won't spend too long on this first slide. So this is just the headlines of the year. We'll cover more of the detail as we work through. But revenue was 38.9 million, 5% down on last year. Underlying operating profit of 4.2 was 27% down on last year. The two key reasons behind that are, we'll come on to, but essentially it's the full year impact of COVID and the scaling up of our investment in national accident law. We generated profit before tax of 0.2 million, so that's 400k higher than last year. We generated a free cash flow of 0.8 million, reducing our net debt down to 15.5 million. In terms of some of the detail, 26.6 million of the 38.9 came from our consumer legal services business. That was down 10.1% on the previous year. Three key drivers behind this. So firstly, the full year impact of COVID restricted the volume of inquiries we could generate in a year, so we generated fewer inquiries as a result of the pandemic. We increased the volume of inquiries placed into our law firm, so they were up 130% year on year. And finally, with some regulatory reforms coming during the year. So the Civil Liability Act was enacted at the end of May, and this impacts the revenues we can earn on lower value RTA claims in the market. And since the reforms have come into effect, we've taken all of our volume into national accident law on RTA claims since that period. In critical care, we delivered revenues of 12.3 million, so they were 1 million higher than 2020. And we've seen good volume growth across both the expert witness and the case management sides of the business. We'll come on to that in more detail as we work through the presentation. An underlying operating profit level, I've already talked about the 4.2 million that we generated at a group level. For CLS, that was 3.7 million, 1.7 million lower than 2020. All the revenue reasons I talked about previously contribute towards that, but also we've had to scale headcount in the law firm to process the increased book of claims that we're working through. In critical care, underlying operating profit was 3.3 million. That was 0.3 million lower than 2020, and that's due to investments in people, market activity, and systems as we look to further grow the business. Again, more on that shortly. Non-controlling interests, so that's the profit share with our joint venture ABS partners. That was 3.5 million, down from 4.1 million the year before. That number will continue to fall as we change the shape of our claims that we process within the JV ABSs, and that will result in the 0.2 million of profit before tax that I talked about earlier on. From a cash point of view, the shape was different in 21 versus 2020. So in 2020, we prioritised placement with a panel for quick cash and liquidity as the pandemic hit. In 2021, we've reverted back to our strategy of growing the law firm for longer term future value. So as a result, our free cash flow was 0.8 million in the year. That transferred to our net debt, which reduced from 16.3 million down to 15.5. And also, I think it's worth pointing out that within the cash receipts during the year, 2.1 million of that came from cases that had settled within national accident law. So that was up 62% from the year before. Finally, James touched on it earlier on. We've secured our funding with Yorkshire Bank for a further 2 years out to the end of 2024. So tying down our working capital, available working capital for the medium term. Okay, I'm just going to hand back to James now. He's going to cover some more detail behind both divisions.
That's great. Thank you, Chris. So I'll start with Consumer Legal Services division. And our strategy here is unchanged from what we set out last year. And our approach to creating an integrated law firm can be broken down into 2 parts. So firstly, the strategy is dependent on our ability to generate our own work. And I'll talk about the impact that COVID has had on the market in a moment. And whilst we can't do anything about that, what we have done is progress our strategy. Our National Accident Helpline brand continues to perform strongly, and independent research confirms it's the most trusted brand in the sector. We're looking at how we can further strengthen the brand in 2022 with a return to TV advertising, and hope to update you on that in a bit more detail later in the year. We're also seeing the benefit of our previous investment in the website, which is pleasing because the vast majority of our inquiries come through digital marketing. Our website's performance is amongst the best in the sector, and whilst it's difficult to compare 2021 with 2020 directly because the first quarter of 2020 wasn't affected by COVID, if you look at the performance for the April to December period, our website delivered 18% more inquiries in 2021 from organic search than the prior year. And that's really important because those inquiries are essentially free and enable us to focus our marketing investment on the other channels. And that helps us to control our blended acquisition cost. So strong inquiry generation is the first part of our strategy. And the second part is our ability to efficiently process the work that we generate ourselves in NAL for a higher return than placing it in our panel or joint ventures. Now, that's not to say that the panel and joint ventures aren't important to us. They are, because they help us to manage our requirement for short-term profit and cash, and to manage the working capital that processing in NAL demands. But we've always said that we want to process an increasing volume in NAL, as this will help us to build a higher margin business. And we've been really pleased with the progress that we've made in this area. We're processing more inquiries in NAL than ever before. So 26% of all inquiries in 2021 compared to 10% in 2020. And this pace of growth hasn't been easy. So we've had to recruit more fee earners and paralegals, and we've had to scale the processes. But we've got new leadership in the division, and they and the team are doing a fantastic job. And by bringing these two parts of our model together, we can build an integrated, sustainable law firm capable of generating higher margin returns, which is underpinned by our flexible placement model. Now, before I move on, I want to just touch on Homeward Legal, which is our conveyancing business. And we've said in the past that the activities of this business aren't really core to the group's strategy. We've been exploring a potential disposal of this business, which would enable us to release capital that we can then use to pay down debt and to help fund the growth in the other businesses. Unfortunately, completing the deal in 2021 wasn't possible because of a number of external factors that were beyond our control. But we will continue to explore options for this business in 2022, and I'll come back and update the market in due course. Thank you, Chris. So over the next few slides, I'm going to update you on the performance of our personal injury business in 2021. And I've broken this down into three areas. So firstly, inquiry generation, and then placement, and then processing in NAL. And we'll start with inquiry generation. As Chris said earlier, the market continues to be depressed because of two factors. Firstly, the impact of the restrictions that the government put in place in response to the COVID-19 pandemic. And secondly, the impact of the reforms contained in the Civil Liability Act, which was implemented in May of last year. And when it comes to COVID, over the past couple of years, we've found that the Google mobility data is a really good leading indicator of accident numbers in the UK. And you can see how that's evolved. That's in grey, the area in grey on the chart on the right-hand side. Mobility levels dropped quite sharply as each lockdown was announced, and then gradually recovered, although mobility levels didn't recover above 75% of the baseline since the start of the first lockdown. And official claims data in the industry, that goes to November 2021, and you can see, this suggests that the level of claims in 2021 was around about 60% of 2019 levels. So you can see the extent to which the market was depressed over this period. Now, our marketing delivered just over 32,000 inquiries in 2021, which was lower than the prior year, but that was because we didn't start to see the impact of COVID in 2020 until the second quarter. Again, if you look at the April to December period, we delivered 10% more inquiries in 2021 than 2020, which is really encouraging. We've also noticed that since the reforms in May, we've been capturing more RTA claims, and we've been consistently growing market share in this area. So if I turn now to placement, the triage inquiries that we place into NAL, well, they can take 3 years to process. So placement into NAL generates longer cycle revenues, profits and cash, but at a higher margin than we can earn through the panel firms or our joint ventures. It does, of course, require more working capital, whereas our panel firms can deliver a short-term profit and cash. And that's why I believe that our agile and scalable placement model delivers us the flexibility to enjoy the best of both worlds. And I said earlier that we allocated more inquiries to NAL in 2021. So yes, it was 130% more, in fact, and we've carefully managed the level of inquiries into our joint venture firms. This should help us to build a higher margin business, but we're still placing the majority of our claims into the panel to help fund our future growth. And since the CLA reforms were implemented, we've been placing all of our RTA inquiries into NAL. That includes small claims. And importantly, in the second half of the year, we started placing an increasing number of non-RTA claims, which are generally of higher value to us. So finally, for PI, then we'll look at claims processing in NAL. And well, since we started NAL in 2019, two of the questions that I get asked the most are: when can we see evidence of value that we can realise from claims we've put in? And secondly, how accurate do we think our model assumptions are? And it's been really difficult to answer those questions because the book of claims hasn't been mature enough to give us any meaningful data up to now. But now I think we're in a position to understand that a bit better, and I want to share with you the results that we're seeing. So what we have on this page is an analysis of all of the inquiries that we allocated to NAL in 2019, which we called the 2019 cohort. And remember that NAL didn't start trading until April 2019. In total, we put in over 2,400 inquiries in 2019, and using our assumptions at the time, we estimated that these inquiries would ultimately be worth revenues and cash of £2.3 million. We now know that to the end of 2021, we've won 923 claims, which has resulted in us collecting £1.7 million of cash over those 3 years. In addition, we have 481 ongoing claims, which we're still processing, and based on our assumptions, we believe that they'll convert into a further £0.7 million of future cash. Of that £0.7 million, £0.4 million has been accrued and is sitting on the balance sheet, and that's consistent with our revenue recognition rules because we've already had liability admission from the defendants in those cases, and typically we accrue around about 70% of the revenue or future cash, as we're confident that we're going to win that claim. The other £0.3 million hasn't yet been recognised in the profit and loss, but we believe we've still got a good chance of being successful in those claims. So to summarise on this slide then, our model assumptions initially valued the 2019 cohort at £2.3 million, and after working on these claims for 2 to 3 years, we've upgraded that to £2.4 million. And we've only got about 0.3, that's about 12% unrecognised, which we're really pleased with. This next slide repeats the analysis for the 2020 cohort, and conditions in 2020 were quite different because the legal industry suffered delays as the country went into the first COVID lockdown. And as Chris said earlier on, the focus for our business in 2020 was all about trying to prioritise placement into the panel to generate liquidity. And so the vast majority of these claims would have been allocated to NAL towards the end of 2020. So as a result of that, it's going to take a little while longer for this cohort to mature. But nevertheless, the results are encouraging. We've already won 950 claims, and we've collected in 1.5 million in cash. We estimate that the 2020 cohort is worth £3.5 million. And of the £2 million that we think is still to come, we have £500,000 accrued with liability accepted. So for 2020 inquiries, the cohort's valued at £3.5 million, of which £1.5 million is still unrecognised. And then this is the last slide in the series, and this shows the progress across all cohorts to December 2021. And you can see the build-up in value over this period. So we put in just over 2,400 inquiries in 2019, almost 3,400 in 2020, and 8,249 in 2021. And we've been collecting in increasing amounts of cash, so 0.2 million, 1.3 million pounds, and then a 62% increase to 2.1 million pounds in 2021. In total, we've won over 2,200 claims, and we've collected in 3.5 million pounds of cash. Our model tells us we have visibility over 8.4 million of cash still to come in, of which 6.7 million hasn't been recognised yet. And the adjustments or the retrospective revaluations of these cohorts over this time net to just 140 grand, which is just over 1% of the total value. So I want to be really clear that NAHL's book of claims is not yet mature. You can see in 2021, for example, we added new claims with an estimated value of £6 million, and we collected just over a third of that in cash receipts in the year. Eventually, as the book matures, the value of the claims the value that we're extracting from the model through the cash receipts will catch up with the value of the new claims we're adding. And these two blocks that you see on the screen will equalise. And that will signal the maturity of the model and the scale up of the business will be complete. We're making good progress with the build, but clearly it's going to take a few more years before the work is finished. So whilst we're not there yet, this analysis, I think, gives me confidence in the accuracy of our assumptions and the sustainability of the business model. So if we turn now to our other division, which is critical care, I'm really pleased with the progress that we've made in our recovery in 2021. So our strategy in Bush & Co is to grow our market, grow our share in our market, by appealing to a broader customer base. And we did grow market share in 2021. And one of the ways that we did this was by investing in marketing and business development to build new customer relationships and to deepen the relationship with our existing customers as well. In 2020, we won an award for supporting the industry at the PI Awards, and we backed that up in 2021 by winning the Marketing Campaign of the Year award, which meant a lot to us because the team worked really hard for that. Our strategy also called for us to extend our competencies and specialisms, and we welcomed 34 new associates in 2021 across a broad range of specialisms, and we also launched new propositions targeted at care and serious injury. Finally, we said we wanted to become more efficient through the use of technology, and in April 2021, we rolled out our proprietary report writing tool for expert witness services, which will help us to be more efficient and maintain quality and to increase the capacity for future growth. If we look at the performance of the division in 2021, you can see the progress that Bush & Co has made. We increased our revenues by 9%, to £12.3 million. Our expert witness services had a really strong year. They grew revenues by 17%, and that was driven by a 21% increase in the volume of reports issued. And it was particularly pleasing to see the number of reports issued in the year exceed the 2019 pre-COVID levels by 4%. In case management, the picture is a bit more complex. Initial needs assessments, or INAs, which are the reports that our case management associates produce, they were up a fantastic 26%. We also saw an increase in the number of open cases, which help us to generate recurring revenues. However, the amount of face-to-face work that our associates do has not yet recovered to pre-COVID levels, as our vulnerable clients and our associates have been managing the risks of COVID-19. And that's depressing the average invoice values, because we can't charge as much for online meetings. As a result, our revenues in case management were flat year on year. But thanks to the focus on marketing and business development, our instruction volumes grew strongly. You can see that on the chart on the bottom right. With expert witness instructions, they were up 23% on 2020, and INAs were up 6%. So not only did that help to fuel the growth in 2021, but it means we've got a bigger pipeline of work to take into 2022. Our profits were down 8% to £3.3 million, but this was largely due to the investments that we made and the initiatives that we launched. We anticipate that these will enhance our growth in the future. So to summarise then, despite the challenges presented by COVID-19, NAHL has made good progress in developing our personal injury business. We collected £2.1 million of cash on settled claims in NAL, and we increased the number of claims that we're working on in our law firm by 166%. We've increased revenues in our critical care division, and we invested for the future. We've reduced net debt, all whilst remaining profitable. And finally, we improved our pipeline of work going into 2022 in both NAL and Bush & Co. And this should result in strong cash generation and greater returns over the coming years. Turning to the outlook, I'm pleased to report that this progress has continued into 2022. Inquiry numbers in PI are growing. They're 42% ahead of last year for the first 2 months of the year. And we've seen modest but sustained sequential growth in the average daily run rate each month for PI inquiries since December. As we've committed to, we've increased our placement into NAL, and we've put 31% of total inquiries into NAL in the first 2 months of the year. That compares to 23% a year earlier, or 26% for 2021 as a whole. In critical care, we've also continued to grow our volumes in expert witness and case management, and our flow of new instructions continues to build. And we plan to continue our focus on managing down net debt over the medium term. And finally, just another quick reminder that our broker Allenby Capital has recently initiated research, and this is the first time that we've had research in the market for over 18 months. So if you haven't already done so, I'd encourage you to have a read of that too. So that brings the formal presentation to an end. On behalf of Chris and I, thank you for giving us your time to listen to us today. Just to remind you that our next scheduled update is our AGM, which will be in June. I look forward to speaking to you then. But in the meantime, I think we've got lots of questions come in, so we'll answer as many as we can. But if we don't answer your question today, I'll try and publish a response on the IMC platform in the next 24 hours or so.
James.
So, yeah, I'll now hand back to Alessandro. Thank you.
James, Chris, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated on the right-hand corner of your screen. But just while James and Chris take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. We received a number of pre-submitted questions from investors ahead of today's event, and I want to start off the Q&A session with these. The first one reads as follows. How has the competitive landscape changed in the RTA claim industry since May 31st, 2021?
Yeah, thank you. I'll take that one. So just to remind you, May 31st was the date that the CLA reforms were implemented. And prior to this, we predicted that immediately after implementation, the market would be highly competitive and volatile, and that would start to calm down probably 6 to 12 months later, as some of the firms in the market exited and others adjusted their appetite to fit the new financial model. And what actually happened in that time is the market was very competitive and highly volatile, and it's remained so since. This is a combination of the reforms, but also the impact of the COVID-19 restrictions being in place for longer than anyone initially thought. So you have a lot of firms still fighting for a reduced volume of claims. There's also not been the stimulus of TV investment in the market for some time, which traditionally has been really a really big driver of activity. And this is quite unfortunate for us because as we're one of the leading brands, we'd also benefit quite significantly from any of the major players advertising on TV. So whilst we can't do anything about the state of the market, we've been carefully managing our own activity in this time. As I said, we've been investing in our website, we've been investing in our organic search performance, and this has helped us to keep the cost of our inquiry acquisition flat in 2021. And we've been growing market share, particularly in RTA, which we think might be partly due to some of the competitors leaving the market. And a large part of this growth actually that we're seeing is in the lower value claims, which to be honest is not all welcome. And so we're looking in 2022, we're looking to more actively manage how we attract and how we progress the lowest value claims so that we can continue to grow in fast track, and that can help us build a higher margin business.
Thank you very much, James. That's great. And the next question reads as follows. The revenue and cash charts are good evidence of the accuracy of the assumptions in NAL. Does that give you confidence that you can make a profit in NAL?
Thanks, I'll take that one. So we're currently in investment mode within NAL, so we're growing the volume of inquiries that we're putting in as we outlined earlier on. But by doing that, we're reinvesting all of our profits to accelerate the growth of the NAL book. The charts we outlined earlier on showing the revenue performance and the maturing position of the cohorts, that gives us a lot of confidence in the assumptions or the value of the inquiries we put in there. We previously talked about a 35% margin on this work for processing these cases in-house. That's after taking into account the media costs for generating the inquiry and all the processing costs associated with the law firm side of the division and running the claim. We're moving towards that. I think it's fair to say we're probably not quite there yet. There's no doubt we would have been inefficient as we've been scaling the law firm. We're finding that balance between the headcount and the volume of inquiries going in, but we don't feel we're far off though. And I hope to bring back a future presentation and some more analysis that will further demonstrate our progress in that area.
Chris, thank you very much. Just moving on to the next question. Do you see any regulatory risk on the horizon for the consumer legal or critical care divisions that has the ability to be as disruptive for the industry as the whiplash reforms of the past few years?
Thank you. So as disruptive as the whiplash reforms, to us, no, that's the short answer. There is more reform to the PI industry on the government's agenda, and there are probably three areas that I point to. So firstly, last year the government confirmed that the small claim limit for non-RTA claims will increase from £1,000 to £1,500 in April 2022. And we see that as an inflationary increase and probably something that's long overdue. It's something that we've been planning for. We've been planning for it for quite a long time, and our modelling suggests that as most of our non-RTA claims are quite a long way ahead of this level, it won't have a material impact on our business. And the two other areas I'd point to that are a focus for the government are fixing legal costs for both clinical negligence and serious injury claims. And these aren't the focus of our business. And so the impact on us will be really, really quite minimal, but they are quite serious changes for some of our competitors who are quite heavily invested in those areas.
Thank you very much. You've talked previously about levelling off claims managed in NAL when they reach around 50% of inquiries. If you look beyond that point, what are the opportunities for NAL to grow?
Yeah, okay, I'll take that one. So if I talk about our overall mix of inquiries, so of the 100%, around 25% are what we classify as specialist inquiries. So they include things like medical negligence claims, industrial disease claims in Scotland. We have no appetite of processing those in-house within NAL, so we're focusing on the remaining kind of 75%, if you like. Around 25% of the volume we generate as a business are in the RTA space, and since the CLA reforms came into effect at the middle of last year, we've now taken all those in-house, so we're processing all of that work, and that leaves the remaining 50% being the non-RTA work, which is your employer liability, public liability and occupier liability type accidents, and that's where our focus is as we look to grow the business. Across RTA and non-RTA, we outlined earlier on that we put 26% of our volume into NAL last year, and we want to grow that figure further. It's probably worth pointing you to the Allenby scenario that the analyst has put out. That suggests a growth of total volume placed into NAL reaching 37% by the time we reach 2025. So that's roughly 50% of the 75% target inquiry pool that we've got to go at. Working towards that, we think we can get to that maturity by 2025, and as we see the volume mature in the model, and as that volume matures and starts to settle down, we'll also then see the profits mature, and we'll see that value come out for shareholders, and we're keen to see that profit come through in the maturing P&L. However, once we've proven the model, we could accelerate investment further. So we do have more to go at. If we're only processing 50% of the 75, more to go at, and therefore we could grow profits further off the back of that. But that will have another impact in delaying maturity on the P&L. That's not our focus at the moment, but it is something we can consider in the future.
Thank you very much, Chris. And the final pre-submitted question reads as follows. Could you discuss your current thinking regarding how you plan to allocate the capital from the NAL book, which will be thrown off from 2023 onwards?
Yes, thank you. So we stopped paying a dividend in 2019 as we were going through the transformation in the group, and we were investing heavily in the setup of NAL, and we just have been paying dividends from debt, which clearly isn't sustainable. Since then, the board's focus has been on balancing our strategic investment with paying down net debt. And net debt back in 2019, December 2019, was £21 million. And what free cash flow we've had since then, we've been using that to manage this down. And we've successfully reduced net debt to £15.5 million at the end of 2021. We anticipate bringing debt down further over the next few years, and this is going to help us to reduce our capital risk and financing costs. So whether it's from the settlement of claims in NAL or any potential divestment in residential property, excess capital over and above our investments in NAL and Bush & Co will be used to accelerate the reduction of debt in the first instance. We can think about things like future dividends or share buybacks in the future. They're not off the table, but they're certainly not on our agenda in the short term. And we think this is going to be in the best interest of shareholders.
James, thank you very much for that response. That does indeed conclude the pre-submitted questions. As you can see, we've received a number of questions throughout today's presentation as well, and thank you to all the investors for submitting those. Could I just ask you to open up the Q&A tab and read out those responses and read out those questions and give responses where it's appropriate to do so, and then I'll pick up from you at the end.
Yep, sure. Thank you. So working through them, the first one is from Mark A. I'll read that out. Can you give some examples of the types of new initiatives that you're looking at to grow revenues across the business? We probably talked at length in the last IMC presentation about some of these. So I'll just briefly sort of recap some of those initiatives. So I said earlier on about in personal injury, we're directing all of our RTA inquiries into NAL and an increasing number of non-RTA. I think that's growing that non-RTA number of inquiries that Chris talked about. That's an initiative that we're really looking towards in the future to grow our revenues and they're more profitable generally as well than the mix of RTA that we take. So that's a real focus of ours, is growing our capability and our resources so that we can increase the number of non-RTA inquiries in the future. Looking at some of the other businesses, so looking at Bush & Co, we're constantly looking to increase the number of specialisms that we cover, so bringing in new associates with different skill sets to complement what we have already. And recently, I know we've had a focus on young people and children and bringing in specialisms around that. We also have some new initiatives around our care solutions. So Bush Care Solutions is one of the initiatives we've been developing targeted at an adjacent market to our catastrophic injury market. So it's a service that complements case management and tries to provide kind of like a one-stop shop to clients. So that's something we're focused on in the future. And also Hubs is an initiative that we've talked about in the past, which extends our core competencies in the catastrophic injury level to a different segment, which is what we refer to as serious injury. So this is sort of the 100 to 500k claims. So it's a similar sort of proposition. It's probably a more cost-effective proposition, and we're excited about that in the future as well. So those are probably the initiatives that I'd point to. The next question is from Simon C. Moving forward, do you expect to have no reliance on JVs or partnerships, or will you always have exposure to them? That's a good question, Simon. So I talked earlier on about our flexible, agile placement model. So we've got 3 channels that we can place personal injury inquiries into. So we have our panel, we have our joint ventures, and we have national accident law. They each have their advantages and their challenges. National accident law, of course, is where we can help to build a higher margin business, but there's a working capital burden that we need to overcome, because these claims can take up to 2 to 3 years to process. Whereas at the other extreme, the panel generally allows us to access short-term profit and cash flow. And in a way, the joint ventures is a mix of those two as well. So we can recognise some of that revenue up front, but we don't get the cash in until towards the end of the claim. So for me, I think that's a real strength in our proposition, is having that flexibility across the placement model. And one example of that is maybe in 2020 that Chris referred to earlier on, where we flexed our placement tactics. We placed more volume into the panel, and that helped us to realise £6 million in free cash flow in 2020 and pay down some of our net debt. So I think the flexibility that we've got across those 3 channels is a real strength of ours, and an important part of our business model. So hopefully that answers that question. The next question is from Mark A. Do you see personal injury claim levels returning to pre-COVID levels? I would say probably not. Actually, is my view. If I break it down, and there's 2 reasons why I would say probably not. And if I look at RTA and non-RTA inquiries separately, so on the RTA set of inquiries, they've had a big change in that market. Is the impact of the CLA reforms, which we talked about. That's taken a lot of value out of the market, and the amount of compensation that consumers can access for the lower value, the whiplash injuries, has substantially reduced. That is going to reduce, and it already has reduced, the propensity of consumers to claim. And for that reason, I don't think the number of claims, is going to get back to pre-COVID levels. What's that reduction look like? Well, different people have a different view on that. Could it be 10% lower? Could it be 20% lower? Yes, probably could in that sort of ballpark. But in my opinion, I think it will be lower. On the non-RTA claims front, I think, again, we probably won't get back to 100% pre-COVID, because the world has changed. So if I just think about the way people work nowadays, a lot of people are working from home, either on a permanent basis or 1, 2, 3 days a week. And just walking around London, as an example, you see far fewer people queuing up outside the sandwich shops at lunchtime. There's just a lot less activity around the place, and that will result in fewer accidents and fewer customers who are going to be requiring our help. So I don't think it'll be a hugely significant reduction in the market in non-RTA. Again, could that be 10%, 15%? Could be 20%. It could quite possibly be that. But I think the market will soften. But there's still a lot of improvement I think we can expect to see in the market as now that the COVID restrictions have been released and activity levels increase. So hopefully that's answered that question. The last question, Mike W. Can you comment on future dividend policy? Well, I think we've probably covered that off, hopefully, in an earlier question. Future dividends aren't off the table. The board regularly reviews our capital allocation approach, but I think we believe at the moment the best use of excess funds is to reduce our debt levels. And obviously we're investing for the future in the business anyway across both of our divisions. We see lots of opportunity for that, but I think we prioritise reducing net debt, and then in the future, as that comes down, we can look at other options like dividends and share buybacks.
Thank you very much for that. I think you managed to address all those questions from investors, and of course the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, James, could I just ask you for a few closing comments?
Yeah, of course. Thank you. We're NAHL Group PLC, and we're building a more sustainable future for the business despite the challenges presented by COVID-19. In 2021, we made good progress in developing our fully integrated law firm, National Accent Law, by growing ongoing claim numbers by 166% and increasing cash from settlements by 62%. In critical care, we progressed our recovery, growing revenues by 9%, and as a group, we reduced net debt, remained profitable, and we've had an encouraging start to 2022.
Thank you very much, James, and thanks, Chris, for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of NAHL Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.